In late November 2016, two of the federal government's three superannuation bills successfully passed through both houses of Parliament, with minimal changes to those proposed in the May budget. The two bills received royal assent on the 29th of November, at which time they became the following Acts of Parliament: Treasury Laws Amendment, Fair and Sustainable Superannuation Act 2016, and Superannuation, Excess Transfer Balance Tax Imposition Act 2016. In a joint statement, Treasurer Scott Morrison and Revenue and Financial Services Minister Kelly O'Dwyer said the government had secured parliamentary passage for the most comprehensive suite of superannuation reforms in a decade, delivering on its commitment to improve the fairness, sustainability, flexibility and integrity of the superannuation system. Australia's third quarter economic growth shrank by 0.5%, which was the first quarterly decline since March 2011, when floods in Queensland interrupted a significant part of the nation's coal production. The quarterly contraction meant annual GDP growth fell to 1.8%, the lowest recorded level since March 2009, and down from just over 3% per annum recorded for the previous quarter. The weakness in the September quarter GDP was largely due to poor retail sales, which kept consumer spending growth lower at only 0.4% over the quarter, resulting in a contribution of just 0.3% to quarterly GDP growth, a fall of 1.4% quarter-on-quarter in dwelling investment, a large decline in public spending of 2.4% quarter-on-quarter, and a contraction of 0.2% from growth by net exports. The US Federal Reserve moved to increase its target range by 0.25% to a target range of 0.5% to 0.75% at its December meeting, just the second increase in a decade. The Fed also indicated that there was a likelihood of three further 0.25% moves in 2017. Fed Chair Janet Yellen said, "Our decision to raise rates should certainly be understood as a reflection of the confidence we have in the progress the economy has made." The decision was also prompted by low unemployment, rising inflation, and strengthening of economic growth. At its December meeting, the ECB signalled the continuation of an extremely accommodative stance in deciding to extend its QE program by 9 months, although at a reduced rate of monthly asset purchases. The ECB stated that the bond buying program will continue until the end of 2017 or beyond if necessary, and in any case until the Governing Council sees a sustained adjustment in the path of inflation consistent with its inflation aim. From April 2017 until the end of the year, the program will continue at a monthly pace of $60 billion, down from the current $80 billion. The RBA kept its cash rate steady at 1.5% at its December board meeting, citing expectations of stronger economic growth in 2017 as the recent rise in commodity prices filter their way through the economy. RBA Governor Philip Lowe explained in his accompanying statement that commodity prices have risen over the course of this year, reflecting both stronger demand and cutbacks in supply in some countries. The higher commodity prices have supported a rise in Australia's terms of trade, although they remain much lower than they have been in recent years. The higher prices are providing a boost to national income. Lowe also noted that financial markets are functioning effectively, with government bond yields rising further. He added that funding costs for some borrowers have also risen, but remain low, and globally, monetary policy remains remarkably accommodative. The most recent ASIC retirement standard figures for the September quarter showed that couples aged around 65 living a comfortable retirement needed $59,619 per annum. Singles required $43,372 per annum for a similar outcome, both of which represented an increase of 0.8% over the prior quarter. The cost of living for older retirees, aged 85 and over, increased by a little more at 0.9%, with a rise in funds needed for a comfortable retirement driven by higher prices for groceries, electricity, and property rates and charges. During the month of November, fixed-rate home loans proved to be increasingly popular with borrowers, with 1 in 5 mortgage holders opting for this type of product. According to the latest national home loan approval data from Mortgage Choice, fixed-rate home loans accounted for 19.5% of all loans written in November, up from 17.4% in October. This was in direct contrast to the broader trend for the year, during which fixed-rate home loans had fallen out of favour with borrowers. The demand for fixed-rate mortgages was greatest in New South Wales, accounting for 24% of all loans written. Queensland was not far behind, with fixed-rate mortgages accounting for 21.55% of all loans written over the month of November. ASIC has approved a new code of practice for FPA members who engage clients in ongoing fee arrangements, removing the need for the advisor to comply with opt-in laws implemented under the favour reforms. The Corporations Act allows ASIC to exempt a person or class of persons from the opt-in requirement, provided it is satisfied that those persons are bound by an ASIC-approved code of conduct that removes the need for persons bound by the code to be bound by the opt-in requirement. The objective of the FPA's Professional Ongoing Fee Code is to achieve the same outcome as under the legislative requirement. In effect, this is to ensure that a financial advisor cannot receive payments from clients without providing them a service, and clients must actively sign up to an ongoing service and fee arrangement.